You think countries go broke like people go broke? Wrong. Countries don't go broke. They choose. Nobody noticed that the world is $307 trillion in debt. Nobody noticed that Japan, the world's fourth largest economy, owes more than 2.5 times what it produces in a year. And the bond market just yawned. Nobody noticed that Argentina collapsed in 2001, Greece in 2010, Britain in 1976, and every single time the warning signs were identical, and every single time the world was surprised. Nobody noticed the sovereign debt trap. This is not a story about numbers. This is a story about who breaks first, and what happens to everyone else when they do. Japan owes 260% of its GDP. For comparison, Greece collapsed at 177%. Argentina defaulted at 150%. The United Kingdom went to the IMF at 120%. Japan is at 260%, and the bond market does not care. Why? Because 90% of Japanese government debt is owned by Japanese citizens. The Bank of Japan, Japanese pension funds, Japanese banks, Japanese grandmothers buying government bonds at the post office. Japan does not owe the world. Japan owes itself. But here is the crack in the armor. Japan's population is shrinking by 800,000 people every year. The workforce is contracting. The tax base is eroding. Social security costs are exploding. The people buying the bonds are the same people who will need their money back. And the young people who are supposed to pay them back? They are not having children. They are not earning enough. They are not there. This is the Japan debt crisis, not a crash, but a slow suffocation. A country borrowing from its own future at interest rates so low they look like trust. But trust is not a financial instrument. Trust is a bet, and Japan's bet is getting old. The United States owes $37 trillion. Interest payments alone are now over $1 trillion per year, more than the entire defense budget. More than Medicare. More than any single line item in the federal government except Social Security. And yet, the world keeps buying. Not because the world trusts American fiscal discipline, the world does not. But because the dollar is the only currency that matters. Oil is priced in dollars. Global trade is settled in dollars. Central banks hold dollars as reserves. When a crisis hits, the world does not buy gold. The world buys US Treasuries. This is the sovereign default explained paradox. The United States cannot default because it prints the currency it borrows in. It can always print more. It can always pay. But printing more devalues the dollar. And devaluing the dollar punishes every country holding dollar reserves. China, Japan, Saudi Arabia, the entire global financial architecture. This is why China is buying gold. This is why Saudi Arabia is talking about oil in yuan. This is why Brazil and Russia and India and South Africa keep holding summits. They are not trying to destroy the dollar. They are trying to build a door. And the United States is handing them the keys by borrowing like the debt doesn't matter. Because when you print the world's reserve currency, the debt never comes due. Until the world decides it wants a different currency. Here is what happens when the world stops believing. Argentina, December 2001. The government freezes bank accounts. You can withdraw $250 per week. No more. Your money is in the bank is open, but your money is gone. People take to the streets, banging pots and pans, 5 presidents in 2 weeks, 27 people dead. The largest sovereign default in history at the time. What caused it? Argentina had pegged its peso to the US dollar. 1 peso, $1. It was supposed to create stability. It created a trap. When the dollar rose, the peso rose with it. Argentine exports became too expensive. The economy stalled. The government kept borrowing to cover the gap. The IMF kept lending. Everyone knew it was unsustainable. Nobody stopped it. And when the peg broke, when the peso crashed from $1 to 4 pesos overnight, the middle class was wiped out. Savings evaporated. Mortgages tripled in cost. A generation lost everything. This is the Argentina 2001 lesson. Sovereign debt crises do not start when the debt is too high. They start when the world stops believing the debt will be repaid. And belief, unlike debt, cannot be printed. Here is the part nobody talks about. Sovereign debt is not held by governments. It is held by banks, by pension funds, by insurance companies, by the financial institutions that underwrite the entire economy. When a country defaults, those banks take losses. Those losses force the banks to sell other assets. Those asset sales drive down prices. Those falling prices trigger more losses at other banks. Those banks sell more assets. This is the doom loop. In 2008, the US housing market collapsed. Not the US government, not a sovereign bond, just mortgages. And the entire global financial system nearly froze. Now imagine the same mechanism, but the asset failing is not a mortgage in Florida. It is the bond of a country. Greece defaulted in 2012. The debt was held by French banks, German banks, European pension funds. The European Central Bank had to step in. The IMF had to step in. The entire European project nearly shattered. Greece is 0.2% of the global economy. 0.2% nearly broke the euro. Now ask yourself, what happens when the domino is bigger? There is a pattern. Britain. 1976. The pound collapses. Britain goes to the IMF. The IMF demands spending cuts. Britain cuts. Britain recovers. Britain loses its status as a global power in the same decade. Mexico. 1982. Oil prices crash. Mexico cannot pay its dollar-denominated debt. The US Treasury steps in. The bailout is called a success. Mexican wages fall 40% in the following years. Russia. 1998. The ruble collapses. Russia defaults on domestic debt. Foreign investors lose everything. The Russian people lose their savings. Vladimir Putin rises to power 3 years later. Argentina. 2008. Greece. 2010. Sri Lanka. 2022. The pattern is always the same. Country borrows in a foreign currency. Country cannot print that currency. External shock, oil price, war, pandemic, rate hike. Currency falls. Debt service explodes. IMF arrives. Austerity imposed. Population pays. New political movement rises. Cycle repeats. This is the sovereign debt trap. Not a bug in the system itself. So who is next? The IMF has already named names. Egypt spends more than half its government revenue on interest payments. Pakistan has been to the IMF 23 times since 1958. Kenya is spending more on debt service than on health and education combined. These are the countries that will break first, the ones that borrowed in dollars, the ones that cannot print their way out, the ones where the IMF is already in the room. But the real question is not which small country defaults. The real question is whether the global financial system can absorb a large country crisis. Italy owes 2.8 trillion euros. Italian bond yields are rising. The spread between Italian and German bonds is widening the classic stress signal. The United Kingdom saw its bond market nearly seize in 2022. A tax cut proposal triggered a pension fund crisis. The Bank of England had to intervene in 3 days. A G7 country. A reserve currency. 3 days from crisis. The sovereign debt bomb is not a metaphor, it is a clock, and the hands are moving. Here is the question nobody is asking. Not which country defaults first. Not whether the IMF can contain it. The question is, what happens to the global financial system when the debt that underpins it is revealed to be a confidence game and the confidence breaks? Your pension, your mortgage rate, your currency's purchasing power. All of it depends on the assumption that governments will always pay their debts. But Argentina paid, then Argentina didn't. Greece paid, then Greece didn't. Russia paid, then Russia didn't. Every sovereign default in history was preceded by the same sentence. This time is different. It never is. The sovereign debt trap is not a crisis waiting to happen. It is the system working exactly as designed. The countries that borrowed in someone else's currency will be forced to choose between default and austerity. The populations will pay. The creditors will restructure. And the cycle will begin again. The only question is whether this time The dominoes are too connected. Whether the debt is too large. Whether the system that has absorbed every crisis for 80 years has finally met one it cannot digest. Nobody noticed. But the bond market is watching. And the bond market never lies for long. The world runs on debt most people never see. Bonds in pension funds. Bonds in central banks. Bonds in the architecture of everything. That's why you're here. That's why this channel exists. If you want to see the hidden forces before they become headlines, subscribe. The next domino will change everything.